I'm Charlotte McLeod with investingnews.com, and here today with me is Dana Samuelson, president of American Gold Exchange. Thank you so much for being here. Great to have you.
Oh, it's great to be here with you, Charlotte. Thanks for having me.
Really good to be catching up with you once again. It's been a little while, but I think it's pretty much the perfect time to be checking in with you given everything that's going on in the gold market. I know you've been doing a lot of work on your YouTube channel to make sure that market participants stay informed about what's happening. And your latest video goes into a big question that I think many people are thinking about right now, which is this movement of gold from London to New York. So you explain this is to do with the tariff situation, but there's a whole lot more nuance than that. So I thought we could begin there. And if you could pull out the key information that you think people should know.
Yeah, okay. So we've seen a huge flow of physical gold move from London and Switzerland in particular, but around the world into New York. This all started in December and it ramped up in January into February, and it's been massive. We saw something similar when COVID hit because demand for gold in the U.S. exploded on the back of that, economic closures and the $6 trillion of printing of new money out of thin air. This time is different. It's because of tariffs. And what happened is the premium difference between what an ounce of gold was worth in London versus what an ounce of gold was worth in New York changed. Normally they're very close, but the premium in New York jumped because if tariffs are put on gold or silver, they're not going to be a couple percentage points. They could be, 10, 15, 20, who knows, which conceivably makes gold worth more in New York in the long run, and silver too in particular. And silver is actually a bigger issue right now. But what happened was, because of the way the market has been set up for decades, the physical market is dominated by the London Bullion Market Association. And of course, the Bank of England has the big vault where they store a lot of central bank gold, 400,000 bars of gold. So the physical market's in London. But if you're hedging and you're selling forward in the futures market, you're doing that in New York. And normally these prices are very close to each other. But when the premium surged in New York, two things happened. If you're carrying a position and you sold it, say, at 2,800, and now the New York price jumps to 2,850 or 2,900, well, you get a margin call immediately. So number one, you've got to pull more money out of your pocket that you didn't expect to make up the 10% margin that you have to have with the COMEX exchange. But more importantly, number two, if you're a hedger, a strict hedger, and you're going to buy that position back at the month expiry and roll it forward, you're going to take a loss on that premium because you sold it lower before the premium surged. I talked with my hands a little bit. Now, if you deliver that gold to the COMEX exchange, you get the premium back and you don't lose it. And remember, the margins on physical gold are tiny. So suddenly you're losing 3, 4, 5% on a premium. It's big money. And for the big bullion banks like HSBC or JP Morgan Chase or Goldman Sachs or Deutsche Bank and a couple of others, to move that gold, deliver to the exchange, and not lose the premium surge, causing you a loss, was a big factor in getting that whole movement of gold started. But once those contracts were covered with abnormally large deliveries, you can still do it and make a profit because the premium is still there in New York. And, when this ramped up, the premium difference was about $50, $60 at one point in time. The last I checked, it was down to about 10. I haven't checked in the last couple of days. But silver, by the same token, got to be over $1 higher for physical silver. Now, last I checked, it was about 50 cents. Now, that doesn't seem like much, but if you're moving thousands of ounces, either by airplane for gold or by freighter ships primarily for silver, it adds up. And it's a simple way to make extra money. Plus, once you have it here, then you can loan it out and earn interest, from a lease rate. And these big banks, they have two things that you and I don't have. They have financing and they have storage vaults on top of that. So they have an insider's advantage that you and I don't have. And this is the financial incentive that has driven this whole huge flow of gold and silver into the U.S. I mean, on average for the last year, the COMEX has had about 17 million ounces of gold in it, and now it's up to almost 38 million ounces. So it more than doubled the supply of gold in New York. And silver, I think it went from 20 million to 60 million ounces. But silver is particularly vulnerable now to a supply shock, and here's why. Central banks hold gold as an asset, as a reserve. It's a tier 1 reserve, so you can hold it like a treasury. So there's a lot of gold lying around in the system that's just sitting there. As the Bank of England has said, they've got over 400,000 bars of gold. But it's usually just sitting there. Right now, silver, the stockpiles of silver are not the same. They're much more sensitive to demand because silver is more of a commodity metal. And the available supply has been drawn down much more sharply. If you look at the London Bullion Market Association figures for how much silver they have, they've lost about 30 or 40% of their physical silver. And it's getting close to a tipping point where in gold, they've lost 3 or 4% of what they've held. So silver is much more potentially sensitive to an actual physical supply shock. And if you're a producer and you're going to need silver to make EVs or solar panels or other things that silver required for production, it makes sense for you to pay an interest fee to have it here in the States, already here, to own it, to pay financing on it for 3 to 6 months, than to be subject yourself to a potential tariff if tariffs are enacted. So this is what's driven the whole thing, and I think silver is much more ripe for potentially a supply shock and then a price gain on the back of that if it can break out, which it's trying to right now over 32.50. It's testing. So, and compared to gold's run, the gold to silver ratio today is about 90-1. I haven't crunched it in the last couple of days, but it's high. And silver is undervalued relative to gold. Gold has set new record highs continually all last year and into this year, while silver is still $18 below its 2 previous highs.
Yeah, this is a really interesting situation. And I think that was a good overview of what we see going on there. So many different paths that we can go down. I'll ask you a little bit more about gold and versus silver in this situation, because I know that people were having questions during this time about whether London was running out of gold because delivery times were being extended. It sounds like silver is really, as you've been saying, the one that we have to worry about in that situation. So anything more that you would add on that note?
Well, a couple things. So I do think the actual available pool of physical silver is getting closer to a tipping point. Now, if we go into an economic contraction, that'll be mitigated a bit. But if the economy in the U.S. continues to do well, or if China starts to get better, which is possible, I'm not too thrilled about the Eurozone economic activity for the next 6 months or a year. But if economic activity, India too, gets better, it'll require more silver being needed. And right now, the available stockpiles of silver, particularly in London, are getting much lower, right? Now, with all the delivery delays in gold, you've got to remember, when this situation first ramped up, the traders that needed to get that gold into New York to beat the February contract expiration, they soaked up all the available gold they could get their hands on in the LBMA and the available market, Swiss refineries, number one. So then they went to the Bank of England to borrow gold or rent gold. But the Bank of England is primarily a storage facility. It's not a fulfillment facility. And they're not used to moving this much metal this fast. They've got internal controls. Dave Ramsey said, and it's been viral quote, "This stuff is heavy." And he's actually right. It is heavy. And, you see a spike in what's come out of Switzerland into the U.S. But a lot of those bars, are 400-ounce bars in the Bank of England. And the COMEX exchange accepts primarily 100-ounce and kilogram bars. So that big spike in Switzerland is mostly metal going from London to Switzerland to be reformed by the refineries and then sent to the U.S. So I don't think all the hoopla about the delivery delays out of the Bank of England was just that, hoopla. There's only so much they can handle, and this is not their normal business model.
Yeah, I think that it's good to get your perspective on that. I also wanted to ask, I think we have to talk a little bit more about this whole tariff situation. And I know that it's really in flux from day to day, from week to week. We've seen so many changes already recently. What do we know about whether there could be tariffs on precious metals like gold and silver? What have you seen so far?
Well, my opinion is that it doesn't make sense to tariff gold because it is a tier one asset. And it's equivalent to a treasury. So they're not going to tariff treasuries, right? So why tariff gold? And the commodity uses for gold are about 5% compared to 95% being a monetary metal. So I don't think it makes sense to tariff gold. I don't think, we'll just have to see what happens. Silver potentially could be tariffed because it's not a monetary metal, it's a commodity metal. And we get about, I think Mexico exports about 75% of the world's silver. And they're our top trading partner with Canada. They're our two top trading partners. Now, what's happened with the tariffs that's really interesting is you see Canada as being very reactive to everything we do. Like now there's a tiff between the Ontario President, Doug Ford, who wants to tariff electricity that Ontario provides Minnesota, New York, and Michigan. So Trump announced just today, while we're taping this, that he's going to double the aluminum and steel tariffs on Canada because of that. So this is one-upmanship. It's gamesmanship. And Trump does not want to be one-upped, right? He's trying to be the last voice in the tariff argument. But what's interesting is Mexican President Sheinbaum, I think that's how you pronounce her name, has been much more diplomatic. She's been slow to react. She's been very measured in her response. And I think she's taking a much better look at the long view and how to react to President Trump with respect and dignity, as opposed to just trying to bully, which I think, Premier Trudeau and now President of Ontario, Doug Ford, have both done. So it's interesting. It's interesting to watch, but we're going to feel some pain. I mean, there's no doubt that prices are going to cost more for things that we need in the United States as a result of this. And that's causing a lot of domino effects, as you're well aware of.
Yeah, it's definitely interesting to see this play out here in Canada, where I am going on so strong, like you said. So we're gonna feel these effects too, I'm sure, as this all plays out. I think I have one more point that I want to ask you about on this movement of precious metals situation. So I think you mentioned that spread between the London and New York gold is becoming smaller. So are we seeing this trade come to an end? How is that looking to you?
Yeah, these things don't normally go on forever. And we had an unusually large amount of physical contracts settled for delivery in February. On average, the COMEX will actually deliver 20 to 25,000 100-ounce contracts on a monthly basis. And in February, it was almost 78,000, if I got my number correct. It's a little bit higher than it might be for March at this point in time. But what we're also seeing coming down is not only the premium that gold is worth in New York over what's been happening in London or elsewhere, but we're seeing the lease rates tumble as well for renting gold for a month, 3 months, 6 months. And that, I think, is the pulse more than anything. Because when the lease rates spike to like 9%, that means traders got to have it right now. And that was the February contract expiration, which I think was most of the immediacy of this situation. So it's going to continue as long as there's a premium differential, a higher premium in COMEX. But I think a lot of the easy money or the loss mitigation has already been done. So it might continue a bit further. Now, if tariffs are actually imposed, we'll see, how that all plays out.
Yeah, I think with the caveat for sure that if tariffs play out in any particular way, we could see a change there. So we'll keep an eye on that. We'll see how this whole situation develops. Definitely very interesting so far. And I think tied into this movement of gold is talk about different things that are happening in the US, like talk about if the US is going to revalue its gold, talk about if there's going to be an audit of the gold in Fort Knox. So I wanted to get your take on those situations as well, and whether you think those are realistic things to potentially have happen.
Well, I think we do need transparency. And not having a proper audit of either Fort Knox or the Federal Reserve's holdings, which are about 50-50, about 4,000 tons in each place, Fort Knox in Kentucky and the Fed's holdings in New York, I think that's necessary. The world is calling for it now. And if it's not there, I think it creates a huge credibility problem for the U.S., the dollar going forward. Now, my personal belief is that it's there. I do think that a proper audit that's done methodically, listing every bar, weight, purity, getting a total on it, is going to be a gigantic pain in the butt for the U.S. because I've seen some of the old-time pictures of gold being stored in Fort Knox. And there's one in particular of the Treasury Secretary in 1974, and she's got gold piled up against her on this side, over her head, and down below. And those bars, it's like you pull one out, you're going to get a pile of gold landing on your head. And that's why I think it's a problem to audit, because it's just not stored well the way normal bars might be stored. But I do think that the gold is probably there. And I would be very surprised if it's not, but it'll create a lot of problems if it's not. Now, with revaluation, it's held on our books at $42.22 an ounce. If we were to revalue it to market, that would get the U.S. on paper about another $800 billion of monetary assets that they could conceivably use to spend. But the interest on our debt right now is more than $1 trillion a year. So while it's meaningful, I don't think it's that meaningful. It could still happen, and it's probably overdue for it to happen. But the U.S. is wealthy in a lot of ways. We're primarily wealthy in land. So, that's how we could raise money if we wanted to sell land that the federal government owns. And President Trump's actually talked about selling, 450 federal buildings around the country to raise money. I'm not sure I necessarily agree with that, because it's like our national parks. You want to hold on to these things for perpetuity. You never know. But that's a possibility as well. But revaluation of gold will help a little bit. But in the great scheme, our finances are pretty bad, which is why President Trump's doing everything he's doing right now to help hold our spending in check, which has been, rampant, and potentially grow the economy. But I think we're going to feel pain, which is really what this whole last week's been about, before we feel the gain. And I'm afraid that the pain will be too much for the country to bear before the fruits of all that will be felt economically. And President Trump only has 2 years to get this done, a little less than that now, because when the midterms come, typically any president that holds all three entities of government, the presidency, the Senate, and the House, they lose one of those at midterm, usually the House, which means gridlock.
Yeah, the clock is really already ticking, and I know that he's moving pretty fast, but time is also going fast as well. So maybe we talk a little bit more about this pain that's coming, because when we talked this past summer, and we're speaking about the possibility of a recession in the US, and I think you told us, it's the most anticipated, talked about recession that hasn't happened, and we're still kind of waiting on it despite this past week of pain. So any further thoughts on that updated right now?
Well, there are some growth concerns, economic growth concerns, that are just percolating to the surface now in the last couple of weeks. And a lot of it has to do with this tariff uncertainty, because no one really knows how much input costs might go up. And the U.S. economy has been the beneficiary of a bout of economic exceptionalism. They'll hear that word tossed around, U.S. economic exceptionalism, where we are really the only economy that's performing well in the world today. China's been weak. Japan's been weak for decades. Europe has been hammered by this Ukrainian war. And Germany and France, the Eurozone's number one and number two economies, are at or near recession already. Now, the situation when we talked last summer in Boca Raton was a little bit better, but the U.S. GDP is slowing down a bit. We are at 2.3% for the fourth quarter. We were at 3.1% for the third quarter of last year. We just saw the Atlanta Fed GDP now, which is a measure of GDP right this day that the data is received, spiked from plus 2% to minus 2.8%, just a couple weeks over the last 2 weeks. But that is a measure that really is very choppy until you get very near the very end of the quarter and all the data is received. Now, what's happened is we've seen a lot of front running of tariffs with importers buying everything they can to get it into the U.S. So our imports have been really high, but our corresponding exports haven't been factored into that yet. And that'll help to balance it out. But anytime you see almost a 5-point tumble in two prints on, the biggest economic factor in the world, U.S. GDP, it snaps a lot of heads, and that's what happened in the past week. So we'll see how it goes. I think economists are expecting that we might get 1.5% to 2% GDP in the first quarter, which will be weaker than we had last quarter, or the same. But the employment is still pretty good. We're not, we're going to see layoffs starting to hit, especially government, but the employment market in the U.S. is still fairly healthy.
Yeah. And I think that highlights how slowly these things can play out, maybe even though it feels like everything is happening all at once. I also wanted to bring up the Fed. We've got the Fed's meeting coming up later this month, and the Fed has really been trying to engineer this soft landing amid everything that's going on. So I'm curious to get your thoughts on what you think we may see there when we get this next meeting.
Well, the Fed has caused two major policy errors in the last 4 or 5 years that are on Jerome Powell's watch. Number one, when COVID hit, they overstimulated way too much, both the Fed and the government. And Powell admitted that. I think it was in the December 22 meeting. He finally came clean about that. And then they reacted too slowly to inflation's ugly surge in 2022. And right now, Powell's looking at legacy. And they've done a pretty good job at trying to land this inflation bout that we've gone through without causing a recession by being too tight. And I think they're doing a fairly good job, although the market is starting to say, hey, maybe not, because yields have been holding up where they should be a little bit lower than they are, although they've come off a bit just in the last week or so on the different treasury yields duration, as we're getting some concerns about, U.S. economic growth going forward because of all these tariff uncertainty. So the Fed's done a pretty good job. I think they might cut 1 or 2 times this year. The odds of them cutting 3 times, jumped up in the last 2 weeks because of all this stuff that's been happening with the tariffs. So the market is now anticipating that the Fed may cut 75 basis points this year, but for the next couple of months, they're sidelined. It's Donald Trump is the elephant stomping around the room, not Jerome Powell.
I think that's a good way to put it. There's a lot of things that we're kind of just waiting to see how the rest plays out. So we'll put that one in that bucket as well. So we've been talking about a lot of factors that are positive for gold, as of course we can tell in gold's recent price action. Any other factors that you're watching right now that you see strongly impacting gold?
Yeah, we've gone through this real frothy phase where, when President Trump was elected in November, gold was 2,800. It went down to about 2,650, and then rebounded back to about 2,800 when he took office. This whole tariff concern punched it all the way up almost to 3,000. And then we went into a corrective phase, right, where the froth is kind of coming out of the market. It's healthy. I would have thought that the correction we've been going through for gold in particular would have been more pronounced and prolonged, possibly taking gold down to 2,750, maybe 2,700 on a technical look at the charts. But what's happened since February 28th is something very dramatic and meaningful, which is President Trump and President Zelensky had that public fight in the Oval Office, which signaled a gigantic shift of U.S. policy, eliminating 60, 70 years of, hey, the U.S. has got Europe's back. And now we're saying not only that we're probably not going to support Europe, but we're certainly not going to continue to support Ukraine because Donald Trump wants that war to end. I don't blame him for that. It's been a vicious, brutal, ugly situation. Well, what's happened is a couple things. Number one, if we're going to slow down our military expenditures and that we give to the Ukraine, remember, a lot of that money that we use goes to our own arms manufacturers, buoying up the U.S. economy. We're not sending them money. We're sending them arms that we produce here. So if we're going to slow that down, that's going to be a slowdown of U.S. economic growth. But by contrast, Europe has vowed a pledge, Germany, France, Great Britain, to supplement that. So how does all that translate? Well, the dollar's taken a huge tumble. In the last week alone, it's fallen on the U.S. dollar index from about 107.5 to 103.5, which is just a complete collapse as money has moved out of the U.S., out of our stock markets, as you can see. That's pretty obvious. And out of our currency and primarily into the euro and the yen. The euro and the British pound, which have surged on the back of this dollar collapse. And that has helped to buoy gold because the gold and the dollar tend to trade inversely. So I think the correction that we would have gone through for gold would have been worse than it has been, especially in the last week with gold bouncing off of 28.75 in the spot market back over 2,900 and holding higher right now, simply because the dollar took a big tumble and gold and the dollar tend to trade inversely because most of the consumers of gold around the world buy it in dollars, but they buy it outside of the U.S. So when the dollar gets strong, it costs more. Than when the dollar gets weaker, it costs less in their currency. So there's more demand when the dollar's weaker for gold. And I think that that's contributed to the gold being better off right now than it might have been otherwise. And a lot of people are looking at it going, oh, it's just going sideways. Well, actually, it's really performing quite well right now compared to where it might have been otherwise, especially with the liquidity event that's happening in the stock market. Usually when stocks take a big tumble, gold gets caught up in a liquidity event. I call it throwing the baby out with the bathwater. It's just like gold gets sold off too because everybody on Wall Street's just raising cash, right? They're selling everything they can. And then like a day later, which has happened today, gold's rebound, they realize, oh, we got to get the baby back. And they go and they bring the baby back home. And that's kind of what's happened today. We've seen gold rebound from yesterday's extreme stock sell-off, while stocks are still a bit sideways today. So I think gold's looking really good. And underneath that, more importantly, as we got the 2024 World Gold Council total for how much central banks have bought in 2024, and it's just a little bit less than 2023, and that's just a little bit less than 2022. All three are over 1,000 tons a year, which is double what they've been buying for the previous 10, 11 years. And that's because of the weaponization of the dollar. So central bank appetite for gold across the board last year was the third highest record level and just a little bit below 2023's number, in spite of the highest price we've ever seen gold trade at.
I think that's certainly very significant. And this leads well into my next question, which is about your gold price outlook for 2025. So looking at the rest of the year for the metal, do we need to see more of a pullback than we've seen? Because you mentioned it's been quite well supported here. What are you seeing for gold for the rest of the year?
Well, I think that there's underlying the gold market in the U.S. dollars, there's a lot of support for gold at 2,800. I would be really surprised if we got into a real correction and gold got much below that, if at all. And that's kind of what I was looking for on this correction that is mitigated by this dollar weakness we talked about a minute ago. I don't see much changing in the great scheme of things. If we do see the U.S. go into a recession, a real recession, later in the year, which is possible, probable, I don't know, we could see gold come off a bit. The trend is your friend, and the trend for gold is higher still. That hasn't been broken. So I'm still thinking we could see $3,300 to maybe $3,500 gold this year before all said and done. I think silver is the metal of opportunity right now. I think it should be $42, not $32 an ounce, and maybe $50 an ounce. And we might be getting close to that tipping point where it just runs $5 in a day. You don't know what happened. I mean, that's possible. So I really like silver as a better speculation right now. Platinum and palladium are sideways. I think they're good metals for trading. You buy them, both of them between 900 and 940, and you sell them at 1,050 to 1,100. I think that's That's a simple trade. I think they're more tied to the Chinese economic health than many people realize, Japanese economic health as well. But I do think gold, we've had a big gain last year, big gain. So sideways to higher is my call for this year. And I think silver could get the 20 or 30% run higher still, maybe even more than that this year.
Well, I think people will definitely be happy to hear that about silver. I know it's quite a frustrating metal for a lot of people, and also good to hear that there are ways that you can play in the platinum and palladium markets if you want to do those trades there. So good to go into that. Before I let you go, I did want to ask. So we've got a pretty good idea of gold demand at the global level. We know how much central banks are providing support. But what are you seeing among your customers right now when it comes to precious metals demand? What kind of sentiment are you seeing? What are people looking to buy?
Well, our business, we're a physical metals dealer, has been pretty healthy, but that's because we've been buying a lot from our clients and selling pretty much an equal amount. And we saw a lot of selling in the U.S. ramp up last year when gold got over $2,200, $2,300 an ounce. This has not been a U.S.-driven gold market. It's been a globally driven gold market, primarily based on central bank demand and a lot of the BRICS countries not wanting to trade the dollar, but they can't get out of the dollar. It's not easy to do that, but they can buy gold and have gold in a vault, can't be seized or sanctioned. So what's happened is the appetite for gold in the U.S. has been a lot less than you might think it should be, based on the record run we've had in price over the last 12 months. But I attribute that primarily to the lack of fear in the U.S. markets and in the U.S. economy. We had two big blow-ups of physical gold demand in the United States, the great financial crisis, and then when COVID hit. And over the last year, until just recently, stocks have been doing really well. GDP's been pretty good. Employment's been good. There is no fear driving the emotional response right now in the marketplace. Now, that might just be starting to change with the stock market correction that we're going through. And we are seeing some big money move into our market. People who are a little bit concerned, wealthier clients have been making some bigger trades, but the smaller trades from what I would call the average guy on the street are far less than they have been. And I think that some of that's due to inflation's bite. I mean, it's a harder world to make ends meet these days because inflation is not 3%. It's 20% in the U.S. when you add it all up in the last couple of years. So I do think we could see a bit of a change now that the stock market is looking very vulnerable. And it just depends on what happens with the U.S. economy and, what happens with the Fed. If the Fed is forced to really drop rates, that'll buoy gold. And if we get into a worse enough economic situation where they have to stimulate again, watch out. My $3,500 price top might be conservative.
Yes. I think there's so much uncertainty right now. So thank you for at least trying to make heads or tails of what we see happening. Before I let you go, any final thoughts you would leave investors with right now? I know there's a lot going on.
No, I really think that the best course of action, is to have 5 to 10% of your assets in gold as an insurance policy for the rest of your money. It's a way to get your hard-earned savings out of an ever-depreciating currency. And it's a way to beat inflation because gold has held its value. Silver, too, to a degree, especially over the last year. And it's a way to have an asset that has no counterparty risk, right? Its value is not determined by the opposite party producing a result or a profit or paying a rent check. So I do think gold and silver stacking is a great way to go. And it's a great way to cost average as well. Get on a regular accumulation program, but stick to it. A lot of people get started, but they don't follow through over the longer term. That's really the best way to accumulate. And it's what I've been doing for the last couple of years, ever since COVID really blew, because I could see the writing on the wall with our debt just surging. So it's bad news for the dollar. It's bad news for every currency.
Okay. I think that's a good place to wrap up. We can all remember to hopefully be consistent. Really good to have you on to go through all of these topics. I found it really helpful, and hopefully we have you back again soon.
Thank you, Charlotte. I'm available whenever you'd like to have me back. I really appreciate it. It's been wonderful to talk to you today.
been great to talk to you as well. And once again, I'm Charlotte McLeod with investingnews.com, and this is Dana Samuelson with American Gold Exchange.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.